Michael, thank you for putting this on. And I'd love for you to start just by telling people, like, what started this whole transition of just kind of being this kid who went to college and got interested in finance to the place where you've helped thousands and thousands of people the way that you have.
Yeah, so my first gig right out of college was the mortgage industry, and it was the subprime industry. Now, before I get a lot of haters, we were a little bit different than a lot of the subprime lenders. We had to do what's called a net tangible benefit, where we had to improve your finances. So you had to save money on a monthly basis. We had to reduce your term, give you some cash, defer your payments, et cetera. So underwriters were looking at it like, what is the net tangible benefit of them refinancing? So a lot of lenders back then were just like, it don't matter. If their payments go up, they bring cash to closing and their term goes backwards. They fogged up a mirror and we're giving them a loan. That wasn't us. So because we had more stringent guidelines than a lot of the subprime lenders, we had to learn to be able to build relationships with people. And that's what I did. I didn't understand mortgages. I didn't even have a home. I was renting at the time. But very quickly, I was thrust into the mortgage industry and learned a lot of valuable lessons there. One, how to grind. You don't pick up that phone and call people, you won't make any money. And it's no different today. This is an ATM machine. Pick that thing up and call people to build relationships, and you will eventually start seeing money chasing you instead of you having to chase the money. Now, let me fast forward. So I rose through the ranks of that. The first year became a successful loan officer. I won an award in my first year. And quite honestly, it was, I wouldn't say by mistake. I was surprised as anybody else was, because I just wanted to land the interview, because a buddy of mine that graduated a year before was with this firm and said, you should come over here and check this out. And I'm like, that doesn't sound appealing to me. And then finally, another trip over to the house, he showed me the commission checks. Not his, but some of the other top performers there. I was like, get me an interview. So he got me an interview, and I just thought of a strategy. It's like, what's a way that I could win this interview? Because I'm fresh out of college. I have no real job experience. College degree, quite frankly, didn't teach me enough of what I'm going to need. It didn't teach me sales. It didn't teach me how to network and build relationships. What were you going to say, Jeff?
I said, surprise, college didn't teach you everything you needed, right?
Yeah. Right. Good networking in college, but that was about it. That's the value I got out of it. And that was me. Some people have different experience. But I said, I need to come up with a strategy to land this job. And that's when I told the senior vice president at the time, who's your top performer? And he said, it's Natalie. Last year, we hired her. She was newcomer of the year. And I said, I will double her production if you hire me, guaranteed. He's like, that's a bold statement. Called me later on the night and said, yeah, we offered you a job. Let's see what you can do. Had ups and down months and some really great months. And then by October, they're like, hey, we don't normally announce this until the end of December, but in January, when we all get together up in New York to celebrate, we're going to celebrate the newcomer of the year, the best hire that we made this year. And this is, 2,000 loan officers nationwide. We have 17 branches. We were the 9th largest lender in the United States at the time. And he said, it's October, but he's so far ahead, nobody's going to catch him. Michael, you're newcomer of the year, and we'll celebrate 3 months later when we're in January. I was shocked. I was like, I totally forgot about that. I just wanted to get the interview. And then after that, I just needed to earn income. Fast forward, I went through the ranks, became senior manager with that company. They ended up filing bankruptcy on my birthday in 2007. And you saw the writing on the wall.
That was a great year, 2007, 2008. Those were great years. Yeah.
For those prepared, it actually was. That's where we talk about.
There you go. Yeah.
Buddy of mine. He
wasn't for me.
No, me either. I wasn't prepared. I didn't understand this system that we're going to talk about tonight and the rest of the week. So the company filed bankruptcy. And you're like, well, at least I got a nest egg. Well, no. I was 24 or 5 at the time. And just like a lot of 25-year-olds, as soon as it came in, I was doling it out. And heck, I bought a Cadillac that I could have paid cash for, but I'm like, I'll just finance it. And so the income stopped coming in. And it was, so bankruptcy. I was able to last almost a year, but after that year, it was bankruptcy for me. Not just the business. They filed bankruptcy, but I had to file bankruptcy too. I'm like, I can't keep up with the things that I financed. Even though I had enough money to pay cash for these things, I was just hanging on to my cash because it was an asset, right? No, it wasn't an asset to me. It was getting evaporated because of the monthly installment payments on the debts that I had. So the company ended up calling me back about a year later and said, hey, we're resurrecting and we're going to start a new institution. We got the band back together again, and we've got this hedge fund that's going to give us tens of millions of dollars of capital to do this. and we would like you to be director of operations. I said, no problem. It's better than what I'm doing right now. I'm laying tile part-time, basically, with a buddy of mine that owned a tile company. I'm laying tile. I'm like, anything is better than this. So they give me a decent salary, director of operations, and the hedge fund manager that gave them the money was close friends with the CEO. He was out of Connecticut, but his parents lived in Nashville, Tennessee, which is where I'm located. And so periodically when he wanted to come into town to visit his parents, I assume on a private jet. And at the time he's worth $600 million because my CEO got a heads up that he was coming into the office. So he called me immediately. He's like, please don't screw this up. I need you to understand who this individual is. There's certain things you can say, and there's certain things I do not want you to talk about, but he's a very wealthy individual. I'm like, cool, I'm just going to be myself, right? So at the time, we're $600 million. Now he's a billionaire. And it was after a few meetings, I built a relationship with him. And again, relationship is your key to success. So I built a relationship and a rapport with him. And another trip that he came into town, I was like, listen, birds of a feather flock together. I'm in the mortgage business and you guys are super wealthy. And I would imagine if you're doing mortgages, they're big mortgages. And big mortgages are big paychecks. It's also a lot of return. So you can introduce me to these folks. Well, you're going to get your money back faster and I'm going to get to help your friends. And he's like, that's all well and good. He said, but we don't do mortgages. And I was like, kind of assume that you pay cash for everything. He said, no. He said, think about what we do for a living. We leverage other people's money to become super wealthy. We always use other people's money. He said, so we would do that in personal finance as well. And I was like, well, then what do you do? He said, we use lines of credit, simple interest lines of credit. One example is a home equity line of credit. Everything I've been taught in the mortgage industry, and I've still got the book out on my sales floor now. I was taught by a gentleman named Del Vermillion, one of the best in the mortgage industry as far as training. And it's still in the book. HELOCs are credit cards on your home. If you have a customer that has one, offer a cash out loan in order to consolidate the home equity line of credit. Now, if you understand the mortgage industry, again, bigger loans mean bigger paychecks. Bigger paychecks and commissions is because there's more profits in bigger loans. Well, if I increase the loan amount to pay off a home equity line of credit, doesn't that make it a bigger loan? But it's not the financially savvy thing to do. So when this guy told me that we use simple interest lines of credit, go ahead.
I'm going to pause you just for a second because y'all see how smart Michael is. Okay, he's going now, right? And so sometimes I'm going to have to pause him like this to make sure you're all catching up. Michael, while you were talking, 100K nuggets were just flying through the thing. And so let's start with this sentence because I want to make sure you all caught this 100K nugget, okay? The wealthy, okay, success leaves clues. True or false? How many of you believe that? Success leaves clues, right? You can just model what's already working. You don't have to recreate the wheel. And that's part of what we're doing. Like the principles we teach here have existed for thousands of years. We're just applying them in the modern context according to the modern laws. But here's what Michael said that the chat went crazy. Wealthy people leverage other people's money to become wealthy. Now, that scares some people when they hear that, Michael, because they're like, wait, other people's money, doesn't that mean debt? It may not. Depends, right? There's a couple different ways to do that. But nevertheless, I just want you to write that sentence down. I'm sure there's some challenges you have with that in your mind, but that's a big takeaway because more is caught than taught. The second thing that you said that I hope you all caught is that the book that trained the mortgage people what to do when someone had a HELOC said, hey, if you have a HELOC, they taught them to say, that's a credit card on your home, right? And everyone hears credit card and they think bad, right? Credit card, bad. You don't want a credit card on your home. So they would just, Michael, my understanding, they would refinance the whole thing into a normal mortgage, right? Whatever that means, and get rid of the HELOC. Is that true? Am I making sense of that?
That's true, because it would increase the average loan size, which means they made more profits.
And that's what I wanted to get. I wanted to see if they understood. Which way do you think they make more money? Do you think they're making less money by getting them to refinance out of the HELOC, or are they making more money by getting them to refinance out of the HELOC and into the traditional mortgage? Which way do they make more money, with a mortgage or a HELOC? Put it in the chat. Let me know. What do you think? Not a trick question. It's obvious based on what their books is telling them to do. Yes, they make more money on the mortgage. Okay? Just want to make sure they're catching that. I know it's easy for you, Michael. Sorry for the interruption, but I want to make sure they caught that. right?
You're good. You're good.
Okay, carry on.
So, when he hit me with that we use simple interest lines of credit, like a home equity line of credit. And that's when my training kicked in. And I was like, that sounds like totally opposite of what somebody should be doing. And that's when he hit me with the saying that Joe started with at the beginning of the night, that when it comes to Americans, a mortgage is financial crack to middle America. The poor can't afford them. They're not getting qualified for mortgages. And the rich don't use them. I understood the poor part. The rich part, I was very intrigued about. Okay, so what do the rich use? He just told me simple interest lines of credit. And he said, essentially, Michael, you're a dope dealer. And at this point, I'm probably 12 years into my career, responsible for thousands of mortgage applications. And he called me a financial dope dealer. So it didn't sit well with me. So it wasn't like I took this and was like, oh my goodness, my mind is blown and I'm going to start a business around this. No, what I did for a year, maybe a little over a year, was actually try to prove him wrong, because I wanted to feel good about what I was doing. Because at this point, I've got probably 70 to 80 loan officers at my office that I'm in charge of. Plus, I'm director of operations for the company. So there's branches throughout the country that I'm somewhat responsible for. And I'm like, I've got to prove this wrong so that it sits better with me and I can sleep at night. And I couldn't. I proved him right. I hired an actuary. I had one of my business partners today. Actually, his office is on the other side of this one. That's why I keep pointing back here. He's not Uncle Sam, as the American flag shows. But anyways,
it's tax day in America.
we need to poke holes in this thing. Show me where this man is flawed. And as we got into it, he's like, dude, we should do this personally. So I did. So in 2011, I started this journey and I did it personally. And it was a lot of convincing to my wife because, again, she stuck with me through the bankruptcy. But now we've got kids. We had a house foreclosed on. We had cars repoed. Heck, even my four-wheeler was repossessed. So we're like, all right, please don't.
That's a bad day when the four-wheeler gets repossessed. You know things are going downhill. Yeah.
Also, how you know when you're talking to a redneck as well. But anyways, she said, please don't hurt us, right? And I was like, math doesn't lie. I was like, this makes sense. And, worst case scenario, I can always change it back to a mortgage. So we did. We refinanced our entire mortgage. We had about 10% equity in our home, which was at the time what we needed. And I remember meeting the appraiser there, and I had cookies baked. The house was cleaned, and even had a good conversation with the appraiser. Like, look, here's what I'm trying to do. I'm not trying to take equity out of my home. I even showed him my statement of how much I owe. I was like, here's what I'm going to do with this, because appraisers are on the hook for things. If this ever defaults in the future, they'll point back at the appraiser. And I said, I'm not going to take equity out of the home to go buy a Ferrari that I can't afford, right? So this is what I'm doing. What do you think it appraised for? Exactly what the number that I needed, right? So it helps to build relationships, right? So it appraised for that, and I turned the entire mortgage into a HELOC. Okay, so let's slow down on this part right here. Now, this is what's called a first lien position home equity line of credit. And there's many forms of it, right? But this is called a first lien position home equity line of credit. And it's really this simple. Don't overcomplicate it. How many of you have had some type of mortgage and then refinanced it? Did you hold two mortgages at the same time and use money from one to go pay off the other? No, they did it all at the closing table, right?
I'm going to slow that down because this becomes a common question. I'm going to repeat what Michael said. He turned his entire mortgage into a HELOC, specifically a first position HELOC, meaning there's no other mortgage on the property. Some of you are familiar with HELOCs, and whenever we use the word HELOC, your brain has been trained to think a second position. You got your mortgage, and then you got a HELOC after that. That's not what we're saying. We're saying a first position. So the HELOC pays off your entire mortgage, and it's all a HELOC. Okay, good. You guys getting that? We making sense? Oh, Tanya says how? Well, Michael just said, how do they do that? You refinance with a HELOC.
Yeah, and it took a lot of convincing. I talked to no less than 10 banks and credit unions, and at each one, I had to talk to an average of 4 people. Because if I'm talking to a general banker and I said, hey, you offer a HELOC at 90% financing, I have 10% equity in my home, and I want to refinance my mortgage into a HELOC, every single bank initially, every banker, every single banker initially said, you don't have enough equity. I was like, but don't you do 90% financing? Like, yeah. I was like, okay, well, I just want to replace my mortgage, hence the name of the business, right? And they're like, well, how are you going to take 10% equity to pay off 90% of your mortgage? I was like, I'm just going to refinance. The mortgage is gone. Now I just have a HELOC on my home and I don't have a mortgage. So if you had an FHA loan and you're paying mortgage insurance and you're like, you know what, I've got enough equity, I could refinance to a Fannie Mae. You didn't need 70, 80% equity in your home to refinance. It's a refinance. You're not adding debt on top of debt. You are restructuring the debt that already exists. So that's what I did. And I finally landed on a bank. It was out of Idaho. And at the time, I'd never been to Idaho, but they would lend in Tennessee. And finally, I had to talk to an executive there. He's like, yeah, I totally get it. That makes sense. Yeah, we're all in. Here you go. So that's where I got my financing and turned the mortgage into a HELOC. A HELOC is a much different animal than a mortgage. Now that we've talked about what I did, let me briefly tell you about the history of mortgages, because mortgages look a lot different today than they did 100 years ago. A mortgage used to look like a HELOC prior to 1913, meaning you could put money into a mortgage and pull money out any day of the week that you wanted to, well, with the exception of Sundays, right? And I'm talking stories. So let's say you're a farmer. You own a $200,000 farm prior to 1913. That's a big farm. I could come up with like a $50,000 farm or something. But anyways, $200,000 farm prior to 1913, and you owe $100,000. You're like, I need to buy farm equipment, because if I could buy more farm equipment, I could till more crop, produce more crop, make more money. I need $10,000 to buy this farm equipment. So the same day you go down to the bank and say, hey, I owe you guys $100. It's appraised for $200. I need $10,000 so I can go buy this farm equipment. When I sell my crop for 20, 30, whatever it is, I'm going to put it back in my mortgage. And the banker's like, no problem. Let me change the deed for you real quick. There you go. Here's your $10,000. Good luck to you. Same day, it was liquid. Now, you don't have the technology that we do today where it's like literally you don't have to talk to anybody and it's seconds and it's over in your account. But that's how a mortgage worked. It was a two-way street. Money could move in and out freely 24/7. But in 1913, that's when the game changed in this country. Any guesses what happened in 1913 to change the mortgage industry forever?
Let's see who gets it. Put it in the chat. Fed Reserve, they're saying. Fed was born.
Federal Reserve. Federal Reserve is really key in this, because the Federal Reserve is the backstop of banks, and it allows banks to execute what's called fractional reserve lending, which means you give them $1, they have 10 to lend out. You give them $10,000, they got $100,000. You give them $100,000, they got $1 million to lend out. That's why I said when you give them money, it's a liability to them until they leverage it to make higher yield returns, right? So this is where we got to start thinking like bankers. So banks got a hold of this and said, holy crap, we need more deposits. In full transparency, I sit on the board of the bank up in Michigan. Every meeting, guess what the primary concern is? More deposits. Nothing has changed 100 years later. So like we need more deposits, because the more deposits we have, the more we can lend out and the more money we will make. So what can we do? Where are Americans storing their cash? Not under the mattress, not in the banks, obviously, because especially at that time, they weren't trusted, and nor should they be today, in their mortgage, because it was liquid. It was suppressing interest, but it was also semi-liquid to them. They could pull it out anytime they needed it. That's where they stored it. That's why you hear the stories of my grandfather, my great-grandfather. Back in my day, we had a house and we paid it off in 10 years. There's a couple of reasons for it. One, in my opinion, just a better generation. They didn't have Netflix, Hulu, DirecTV, YouTube TV, Peacock. What are all the other ones? There's all the other stuff, right? So they didn't have these distractions. They read books. They were all more disciplined, right? But they also had better financial tools. And that at the time was a mortgage. So the banks got together and said, we need to close that loophole. So instead of them being able to deposit their money into a mortgage, let's make it a closed-end loan. But let's give them a little slice of what they will think is the American dream, and let's make it a 30-year term. That way we can get more of them, right? Now it's cheaper and more people are just going to want to buy houses, and we can make even more loans. That's where the quote unquote American dream came from. But they closed the loophole and made it where money moves in freely but it doesn't come out freely. Imagine today trying to use your mortgage like a checking account. Make 10 grand this month, cool. I'm gonna put 10 grand in my mortgage. Next month, make 10 grand, cool. Put it in my mortgage. At some point, if you have no savings, you're like, holy crap, I can't pay the electric. I put all my money over there. And there's only two ways to get the equity out: to refinance, which is tens of thousands of dollars, or to sell. Neither one of those are attractive, right? And even if you sold, you got 6% realtor fees and title fees and all that other stuff.
Does that make sense to all of you, what Michael just said? That he's trying to help you see that mortgages are closed. I mean, you put money in, but you can't take it out. The only way to take it out is what he just said. You can refinance or you can sell your house, right? Open-ended, simple interest, open lines of credit, different, not closed. Go ahead, Michael. Yep.
So essentially, we're not teaching something new. We're actually going back to basics, like Australia, South Africa, parts of Brazil, Europe. This is normal. This is what they do. And this is why they're out of debt so much faster than the average American. And you look at mortgage debt today, it's the highest that it's ever been. You look at credit card debt today, it's the highest that it's ever been. You look at car loans, it's the highest that it's ever been. At some point, we have to take personal accountability and be like, we may not be able to save this entire country, but we can at least save our household, because it is going to make a turn. And it is going to be painful for a lot of folks. And you don't have to be that victim. You can be a victor in this, just like my buddy was. When I went through bankruptcy, his net worth tripled. So a home equity line of credit allows money to move in and out freely, just like a checking account. I mean, the first card, if I can find it, and my phone is my wallet. It's really efficient. That way, if I lose this, I also lose all my finances, right? So the first card I pull out of here is my HELOC card. That's what I use for my expenses, right? To a certain degree. And I've also got a business card right here. This is a business card that I use. It's attached to one of my LLCs. We'll get into that later. That's an advanced strategy on top of this. But since money can move in and out freely, I could put 10 grand in my HELOC, and 5 minutes later, if I wanted 9 of it out or 10 of it out, I could pull it out. It's liquid. Now think about what that's doing to the balance. See, in a mortgage, when you put money in, money goes to interest first and then principal last, because it's an amortization schedule. If you do a 30-year term, we all know it, first 5-6 years, how much is going towards principal? Next to none. Next to none, right? And the reason being is they know that people refinance or sell every 5 to 7 years. So they're like, okay, before they have a chance to pay off this loan or sell their house, we need to get our profits on the front end. So they're front loaded. Now, I haven't ran the math on today's rates, but rates from 3 years ago, how long do you think it took before your payment, your mortgage payment, affected more principal than it did interest? Now, we already gave you a clue that 5 years in, basically interest-only payments. How many years before the payment flip-flops and actually tax more principal than interest?
Christina says 15, 20 years. Somebody else said 7 to 8, 10,
18
20. 18 and a half. Okay.
18 and a half is based on a 4.25% interest rate on the mortgage, which we're no longer at. So it's actually worse than that. So 18 and a half years before your mortgage payment is chunking down on the principal balance more than it is the interest. In the HELOC world, when money goes in, it goes to principal first, then interest is calculated, right? Just like a credit card. See, I always thought the credit cards were bad, because it was. It was one of the reasons why I went bankrupt. I was financing everything. Credit cards, if you understand and are disciplined how to use them, they can actually be very beneficial. They can actually be not just free money, they actually pay you to use them, right? And we'll get into that later. So since a HELOC is a two-way street, do I now need my checking account where I store funds? No. Can't I store the funds in my HELOC if it's liquid? With my HELOC, I have ATM access, I have check writing capability, I have online bill pay, I can wire, I can transfer out of it, I can do all the things that I normally would in a checking account, I can do it in my HELOC. But instead of it being a liability by storing it in my checking account, I can actually turn it into an asset by putting it into my HELOC, where every time I make a deposit into my HELOC, the bank records that as a payment, the principal drops. Now, they're not waiting until next month or 6 months later like they do on a mortgage to change the interest. They actually do it the very next day. It's called recasting. So a HELOC will recast automatically every single day for free. Try doing that with your mortgage. Some will allow you to do it, not all. But the ones that will allow you to do it, it is highly protected. They won't tell you, hey, have you ever thought about recasting your mortgage? They will charge you hundreds of dollars to recast a mortgage, which means, let's say you got a mortgage, you owe 200 grand, you sell something, make 100 grand, you're like, hey, I want to put it on my mortgage. But I would also like to make my mortgage payment a lot smaller and have it recasted. So let's recast it back to 30 years to drop the mortgage payment. Some will allow you to do it, but they'll charge you hundreds of dollars. And they also limit how many times you're capable of doing that. Why is it protected? Because it benefits you more than it does them. That's why it's protected. But in the HELOC world, that happens automatically every single day for free, right? So now all my cash flow is getting dumped into this home equity line of credit. And when I need to pay bills, I do pay bills. Now, I do it a little bit different than what I'm going to talk to you tonight about, and we'll get into the advanced strategies this week. We're not going to hold anything back. I will talk about it, but I just want to keep it super simple because, again, complexity is the enemy of execution. I want to make this so easy to understand. So now my money is sitting in an account where it's still liquid to me, just as liquid as it was my checking account, but it's suppressing the balance. And here's another thing when it comes to having debt, people focus on interest rate. How many people threw away their 17 years left on their mortgage or 20 years left on their mortgage or 7 years left on their mortgage and refinanced to a 2.75% 30-year mortgage 3 years ago? A lot.
A lot.
All my mortgage buddies were like, dude, it's a fun game right now. We're making hay. And I said, laugh it up. Because when interest rates go back up, you won't have anybody to refinance again. Guess what's happening today? Mortgage companies are falling by the wayside. And not just mortgage companies, banks. In a normal year, 100 banks go under. In the next 12 to 18 months, you're going to see 2,000 to 4,000 banks that are insolvent, currently already insolvent. So in the next 12 to 18 months are going to be very interesting, but also a huge opportunity if you're prepared. So that's what those folks did. But with what's most important in interest rate is two things: time and balance. Now, I'll give you another pop quiz.
Pause. I want you guys to lean in. I know that Michael is delivering a lot right now. What he's about to share, I want you, you might have to squint your eyes a little bit, okay, on what he's about to say with time and balance. And so we're going to go slow because whenever we do math, right, it's hard to do math with a group sometimes. I have more love for the math teachers than I ever have, Michael, after doing these with you. So talk about more important. This is what he said. Here's the principle. Time and balance are more important than the interest rate. And we're going to prove this to you with your numbers tomorrow in VIP, okay? But he's going to show you just for a second. Again, if you're writing notes, time and balance are more important than interest rate. You've all been trained to think about interest rate. Yeah, but what's the interest rate? You're already asking the questions in the chat. Yeah, but interest rates are higher now. Even with an interest rate, what if my interest rate is lower and I have to refinance a HELOC that's higher into? I get it, okay? So this is we're starting to answer your question because you're going to have to see the world differently. Follow the math. We're going to do the math for you so you see that these numbers are right. But here's the principle. Go ahead, Michael. Time and balance.
So interest rate dictates what your payment is. Time and balance dictate how much interest you pay. So I'll say that again. The interest rate dictates what your payment is. Time and balance dictate how much interest you pay. If anybody's refinanced in the last 3 years, I encourage you to get your closing disclosures out. And there's only one page I want you to focus on. It's actually 3 pages now, because in the government's infinite wisdom, they said the good faith estimate that's 1 page is too complicated. So let's make it 3 pages. Mm-hmm. Yeah.
Makes sense.
Yeah. They're terrible. Anyways, so the loan estimate is spelling out, especially on the last page, the 3rd page of the loan estimate at the top. Because I used to ask folks, what is your rate of interest? And they always say 3.5, 3.75. I'm like, no, that's your interest rate. I want to know what your rate of interest is. Nobody could tell me. Now in Australia, Europe, Brazil, South Africa, they can tell you what the rate of interest is. Rate of interest is how much you are actually going to pay for that home, including financing, right? The government forced lenders to disclose this. It used to be called the truth in lending. Now it's called the loan estimate. And it's the last page of it is called TIP. TIP. It stands for total interest percentage. So you may have got that 3.5% mortgage, but guess how much interest you're actually paying? 60, 65, 70, 75. Heck, if it's a higher interest rate than that or a different type of government program, it could be 90%. We've seen 100% tip. What that means is you're actually buying two homes. When you finance it this archaic death pledge way, you're actually financing two homes, one for you and one for the bank. Guess who gets their home paid off first? The bank. That is the modern day mortgage. That's what 99% of Americans are consuming.
And that's why banks have the biggest buildings in every city. And you have the smaller buildings because they get paid first.